Bell Equipment manufactures and distributes a wide range of material handling equipment, both locally and internationally. Bell Equipment's principal manufacturing plant is located in Richards Bay, South Africa. The company has a market cap of 1.8 billion rand, a price to earnings ratio of 6, and it currently pays no dividend. So a company that currently pays no dividend. A few years ago it nearly went bust, but came in with the rights issue, doing pretty well now.
That's right. Now, this company's been around for a long time, since the 1950s, in fact. And back in the 1980s and 90s, this really was the darling of the market. I mean, it had a huge institutional following, and rightly so, because they were doing exceptionally well. Durban-based company, as you say, a couple of years, well, about 3-4 years ago, they got into deep trouble. They had too much debt on their hands, and of course the whole construction side was looking pretty bleak. And they got kind of rescued, and as a result they've come right. And if you look at the kind of earnings we're looking at, we're almost back to the earnings we had back in 2007, 2008. Not quite, but it's been a nice, rapid return. So yeah, it's very different to the other companies we're looking at. This is a manufacturer of big equipment.
So manufacturer of big equipment, the kind of environment that we're sitting in, Bell Equipment. Your thoughts on it?
Yeah, look, there's still lots of family involvement on the specific share as well that we actually like. If you look at the P valuation, it's not expensive. But I think paying no dividend is probably scaring away some of the investors, and that's why I find it at a PE of 6. And then probably if those earnings are sustainable. We saw the same earnings in 2006 and 7. The share price were, I think, sitting at 40 Rand a share, and it came all the way back, I think, to 6 or 8 Rand a share in 2008. So I think markets are probably waiting for some more direction from the company with new results. Certainly doesn't look cheap. But it will all depends. But it's still cutthroat business. I mean, its margins are not the highest, and if something do go wrong, you fall into debt traps, and one of the other factors is liquidity on the stock is low as well. So
okay,
that's a bit of a problem.
Like you say, it was at 50 Rand, now sitting at less than 20 Rand at this stage. Something that you be getting into?
Yeah, look, we're shying away from it because we think it's too cyclical at this stage, and we're a bit scared of where markets are going at worldwide. So we will not go into it. If the liquidity were a bit better, might look at it, because the PF6 do look relatively attractive in the sector. But we're shying away from the sector as a whole, so I'm going to say not hard.
Looking at Bell Equipment, operates in Australia, Europe and Sub-Saharan Africa. We know the type of growth of projections for Sub-Saharan Africa, looking at about 7% in 2012. So they could benefit from all of that.
Yes, as we said earlier, I think the African prospects again look fantastic, but again in the longer term. As you say, they've got tie-ups with Liebherr in Germany and this type of thing. So well connected. No, look, fundamentally I like this business, but I think just to endorse to underline what Gerbrand was saying, I think investors still probably feel a little bit nervous about shares like this. No, once bitten, twice shy. It takes decades to establish a reputation, and it can go overnight, virtually. And this company, I think they've got to just demonstrate to the market that this isn't a flash in the pan, that they are going to get back onto a nice sustainable growth track. I'm sure they will. But that is not necessarily shared by the rest of the market.
So hot or not?
Not hot, unfortunately.
So two not hots on Bell Equipment.